Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. Thanks for coming by. As always, I appreciate you listening. I have a great show for you today. Just going to give you these normal reminders, 10-minute clips on YouTube where you can watch us and see us, put a face to the name. It really helps us as podcasters. If you follow the podcast, write a review, ring the bell on YouTube, do whatever you have to do. Those things really help, and it really does have an impact long term. Let's just get to it. Are you confused about your taxes as a real estate investor? Do you have no idea what you're doing? I hear you because I'm just like you. That's why I brought on Keystone CPA's Amanda Hahn and Matt MacFarland. Let's get to it. This is episode 71 of Zen and the Art of Real Estate Investing with my guests. Yes, you heard it correctly. Second time, two guests, Amanda Hahn and Matt MacFarland of Keystone CPA, and also the authors of the book on tax strategies for the savvy real estate investor, A Bigger Pockets book. Amanda and Matt, welcome to the show.
Thanks, Jonathan. Thanks for having us. Appreciate it.
Yeah, I'm excited to talk to you guys. I've seen you around Bigger Pockets and all through the investing world for so long. Let's start here. Where's the one tax place that real estate investors need the most help right now? Where are you seeing the biggest hole for investors?
Oh gosh, there are so many holes, but I think, we were just chatting before the show started. I think one of the main pillars of having effective tax savings is having good record keeping. It's a hole that many investors need to fill, but it's probably one of the things that people's least favorite topic, because nobody likes to keep receipts. Nobody likes record keeping, but that really is the foundation of tax savings, right? We need to be able to track where we're spending our money to be able to legitimately maximize all of our tax deduction, and maybe even shifting some of these personal expenses that are traditionally non-deductible, but now we can deduct them if they're also used for business purposes.
Yeah, I think people just need to kind of think, real estate investors need to think more like business owners, right? Where it's like, hey, I'm running a business now, and I'm not just investing in real estate, quote unquote, on the side. I'm running a business, and kind of treat it like that, and approach it like that. Yeah,
I think that's smart. And I think it's smart for them to approach that in the beginning. Of course, everyone in Bigger Pockets asks hey, what should I start my LLC before they've done anything? But thinking of it with a business mindset from the beginning is a great recommendation, because then you're setting up things in place like bookkeeping, which is what people are always behind on. We're not doing it all.
Or not doing it all,
yeah.
Yes. And, question we get a lot is like, how should I do bookkeeping? What software should I use? And it's really important, I think, for investors to understand. It's not about your CPA or your tax person's preference in terms of what software, what method. It really needs to be a method that you, as the investor, is comfortable using it, or if you have someone on your team who's doing it just has to be something that they're comfortable to use. And the reason that is so important is because you need to have a system and a process in place that is easy for you to utilize, right? And you're comfortable doing it. It incentivizes you to do it timely. As a CPA, say, I love QuickBooks, but you hate to learn a new software. What ends up happening is you're going to buy QuickBooks and just put it on the shelf and, try to avoid it at all costs.
That never happens.
Yeah, but that's the one thing. I feel like bookkeeping is kind of like the left out middle ground, because I think some people think like accountants are ready to do all your bookkeeping, but that's not really the ideal scenario. It's really you yourself when you're starting, making sure that you're tracking, logging everything, or hiring a bookkeeper so they can deliver a full product to the accountant when it comes time for taxes, right?
Yeah, for sure. And then I think along the lines, though, too, I think the part that gets overlooked based on what we've seen is that the investor's not using that set of financial statements, monthly, quarterly, whatever it is, to kind of tweak business decisions, right? So, a lot of times as you're kind of referencing, right, it's like, yeah, let me, it's March 1st. Let me get my bookkeeping done for last year. And it's like, well, you should have been doing it all along so that you can make business decisions on, hey, yeah, this property is not performing the way I wanted or something, or hey, we had a huge expense out of nowhere that I didn't know about, and what do I need to change? That's kind of harder to do, obviously, if you're trying to do it, after the fact bookkeeping.
Yeah, yeah. Do you guys feel that I mean this actually applies to me. Like I said to you in the pre-call, I'm just going to get my own advice because I know it will help people. But I feel like people are scared of taxes, so what they do is they just like wait. I'll just figure it out at the end, and then they're like, well, I know it's going to be a lot, so I don't do anything. But then they're wholly unprepared, and then we're going into multiple years of trying to get it figured out. Do you find that a lot, that there's like a distinct fear of what they have to pay and how they have to pay it?
Yeah, for sure. I think it's the, bury the head in the sand syndrome. I mean, we kind of all know it's coming. It's sort of inevitable, but you're right. I mean, you start with the concept, the fact that people don't like to do bookkeeping. They don't like to keep receipts. And then over time, it's like, okay, now tax time, I dread it even more, right? But it's really important, I think, especially for real estate investors to understand that as an investor, you get so many tax benefits, right? It's one of the main benefits of being a real estate investor. So all it takes is spending some time to meet with your tax advisor to understand and put some systems in place so that you're not behind during the year. And what we see a lot too, a lot of our clients, when we start out working with them, they're similar to what you're describing, is like the fear and dread. But after a while, when they see the benefit and the power of real estate tax savings, they start to actually love the process. And, we have a lot of clients we see out, at conferences or on social media, actually sharing their own tax strategies. And that's when we know someone has made that shift, completely over to like seeing how tax can help build wealth rather than killing your wealth.
Yeah, that's a great point. And I feel like that's like a confidence building thing. Once you have the confidence to understand what you're doing with your taxes, then you're like, wait, I can save $25,000. Now they can focus better because you guys have trained them what to look for, and also given them, hey, here's what you need to do if you want to get X or Y. It's like a framework that can help them. Because I'm the same way. I don't really want to do it. If I have a framework, it's much easier for me to place things in there. In terms of real estate investors, the opportunities for them to save money, do those trickle down all the way to your like brand new investor who's doing one burr or one flip? Or do they get more advantageous the more properties you have, more opportunity?
Oh, for sure. I mean, it starts with the beginner investor for sure. I mean, as a real estate investor, as I was mentioning earlier, you're a quote unquote business owner, so it's that mindset again of, now I'm going to, anything that's ordinary, expense that's ordinary and necessary for my business, I'm going to be able to deduct it. And that could be, as Amanda mentioned, things that maybe were non-deductible personal expenses before, where you're using your car, or maybe, office supplies or home office, whatever it is, that now we can tweak those and turn those into business deductions. And that doesn't matter if you are a beginner investor or more advanced. Now, obviously, as you get more advanced in real estate and doing different things, the strategies may change, obviously, and they may get a little more complicated depending what you have going on. But yeah, going down, the bare bones, yeah, for sure. The beginner investor can start, deducting expenses and saving taxes against, the rental income at the very least, for sure.
Yeah. And like you said before, that sets the table for them being better tax wise as they grow into more properties. If you don't start really looking at your taxes or bookkeeping until you're 5-10 units in, like you're going to be way, way behind and providing a mess to you guys when they bring in, 5 properties. Oh, wait, no, it's actually 7 properties.
So he talks to the same people we do.
Yeah.
Yeah.
That's what I was
Yeah.
saying.
I know them all. They include myself.
Yeah.
Yeah. Well, so let's talk a little bit about your investing journey as well, because so you guys were both in Big Four accounting. When did you really think real estate was going to be a thing that you would both do in terms of the accounting side, and then when did investing come into it?
Yeah, we both got our start at Big Four. That's where we're married to each other. In case for the rest of the listeners, before this gets weird, right? But
Before this gets weird.
Yeah.
But yeah, so that's where we met. And like I was working in the kind of the high net worth individual group, and kind of my aha moment. I was pretty green, 2-3 years out of college, senior accountant working on, individual's tax return. He was probably in his 60s. He was retired, had a bunch of real estate, and you can quickly tell by looking at the tax return that, hey, I add back the depreciation expense because I know that's not something he's paying for every year, but he gets to write it off. And then you quickly realize that this person's earning a lot of cash flow and not paying any taxes. And it's like, that's when the kind of light bulb went off for me, at least, from a tax planning perspective. And then, Amanda can share her story, obviously her journey too, but.
Yeah, I think it's a really interesting. What we didn't mention was when we worked at Big Four accounting, I was actually in the real estate specialty group. So my job every day was to work with very sophisticated real estate investors, real estate developers. And then Matt was in the high net worth individual group, which are the owners of a lot of those real estate companies. But even then, we just never thought we would invest in real estate. It was always something like really rich people did. And it took, us reading Rich Dad Poor Dad to really have that mindset shift and say, hey, maybe that's something we can do ourselves too.
Yeah, I mean, that's a good light bulb moment for everybody, because you're involved in, helping all these people save all this money on their giant investments. And you guys are obviously making good money, and you're still not thinking yet, hey, like, why don't we do this? Maybe it's because you're so busy, like a lot of people. But what was after Rich Dad Poor Dad? How did you decide, like, okay, it's time, like, we need to be in this as well?
I think it all kind of sort of came together. I mean, I went from Big Four to a smaller CPA firm that had a lot of real estate investors. And so that kind of kept the juices going. We started Keystone CPA back in 2008. So we actually just had our 15-year anniversary a few months ago. So
congrats.
That's kind of exciting. But yeah, I think it all kind of just morphed together. It was kind of like you're seeing clients, you're working with clients do it, you're seeing deals, you're wanting to invest and stuff. And so it kind of all sort of came together, I think.
Yeah, but I will say, like our first investment property was just very scary, even for us. Like, yeah, I think it's shocking for people to hear that. As CPAs, we know all the numbers there is to know. We worked with clients on investing, but it was still a limitation we had to overcome mentally to pull the trigger and kind of buy our own first property. I would say that's probably, looking back, our first property was probably the hardest one to do, just from a confidence perspective. But once we did it, the other ones, just kind of becomes easier and easier.
Yeah. And then as we go along, obviously we spend a lot of our energy building our business and helping clients. And, so from an investing perspective, we're kind of more on the passive side of things. Obviously, we're kind of, we take advantage of other people's expertise and invest in other people's deals sometimes, because.
Yeah, well, that's good advice coming from accountants that, like, syndications are okay. Obviously, you're busy and you're working with other people, but you guys invest in syndications and then some passive similar properties that just for yourself. So, like, this is a question I have for you guys, because I think this is what people really want to know. What type of property investment would give a regular investor the best opportunity to save on taxes? That may not be a great question, but that is a question people will ask all the time. I'm sure you've heard it. If they're saying flipping, long-term hold, short-term hold, Airbnb, which gives the best tax opportunities?
Nowadays, there's so many different types of real estate, right? Before, when we started, it was kind of just long-term rentals. And now you have short-term rentals, mid-term rentals, and rental arbitrage, and like you said, BRRRR strategy. And so there's not really a one-size-fits-all answer here, unfortunately. But I feel like a kind of a big picture perspective, if you're someone who is a full-time W-2, you have higher income, or you're married with two W-2 incomes that are fairly high. And again, this is purely from a tax perspective. Short-term rentals could provide potentially better immediate tax savings than maybe like long-term rental properties. Alternatively, if real estate is sort of your full-time gig, or if your spouse is able to spend kind of more of their time on real estate, then it's kind of like, hey, all those different types of investments could help you maybe just the same, right? So it really depends a lot on what your income level is, whether you have another full-time job or a business you're building outside of real estate, to then hone into, is it long-term, midterm, or is it more in the short-term rental side?
Yeah. Interesting. I think people are always wanting to figure out the best way, but again, like we said before, they still have to have everything in place in order to take advantage of it, or else it will come time and they'll run out of time to actually get the benefits. What are the advantages? Oh, sorry. Go ahead, Matt. I see you.
No, I was just going to say, I think, everyone probably knows this, but worth mentioning too, right? Is, obviously you're going into investments. Amanda's talking about quote unquote tax benefits and advantages, but obviously you need to go into investment from an investment perspective, right? Like which, even if short-term rentals are might maybe provide the quickest tax benefits, if you go and look at your marketplace and, hey, I want to invest locally and the short-term rental market doesn't make sense locally, obviously don't go do that one, right?
Yeah. But that's a great point. And I think that's why it's really important for investors to have investor-friendly CPAs on their side, because then it's more like find a great property, talk to your accountants, figure out how to maximize the tax benefits the best way you can on that type of investment. That's a much better strategy, right? So in terms of a 1031 exchange, can you guys just go over the benefits and any drawbacks to it? Because it's something that people bring up a lot, but over my career, I never really used it that much. I'm not really sure why. I just was always like, I didn't want to do the identification range and feel like I was going to be forced into a property. But investors need to know about it and how they can use it to their advantage.
Yeah. Well, I'll just take a moment to define 1031 exchange.
Perfect.
Effectively, and this is a benefit just for real estate investors. If you have a property that's appreciated in value and it's a rental property, if you sell it and there's going to be, anticipated large gain that you have to pay taxes on, what you could do is to do a 1031 exchange by purchasing replacement properties after the original property is sold. And so when you follow these IRS rules to do a 1031 exchange, the tax benefit is that you don't have to pay taxes right now on the gain that you earned from the first property that's sold. So effectively, you get to defer the taxes and reinvest all of that money from the first deal into the second deal, right? So that's the reason, or that's the benefit of a 1031 exchange. Of course, there are a lot of rules with respect to 1031 exchange.
Yeah, and in our practice, we do see them used a lot, obviously, because with 80-90% of our clients are real estate investors, it comes up a lot. And there can be huge benefits like that, obviously, where you're not getting cut by the tax drag right now. But yeah, pros and cons. That's the pro. Potential cons is not, maybe, it's not for everybody, right? It may not be if you find yourself in a situation. Some people think I just got to do a 1031 exchange because that's what people talk about. I got to do it. But if you go and figure out your situation, it's like, hey, my gain is $5,000 and my tax is $500. Like, well, yeah, you're going to pay more than that to somebody to do an exchange for you, right? So you got to make sure the cost benefit is there. There is time requirements of, as you alluded to, identifying properties and buying replacement properties. But I think the more interesting one that we saw this in an article a couple of years ago, or maybe heard an exchange person mention it from an article, is that there's studies that show that people pay like 7.5% to 10% more for replacement property purchase price than they otherwise would have if they hadn't bought that same property in exchange. Yeah. Because they're up against these time constraints. And so I don't think people think about it like that a lot. It's like, oh my God, I got to close on this property. I got to get my exchange. And it's like, well, no, you just paid 10% more for a property because than you would have then that you shouldn't have paid that based on the numbers and what have you, right? So I think that's something that people probably should be aware of too, is it not just don't jump the gun, just save the taxes, obviously.
Yeah, you kind of have to know all the numbers, like Matt said, how much is my gain? Do I have ways to offset it naturally, like with other losses I have?
Right.
Just, unfortunately, don't have that much of a gain. And so, it's not necessarily a great strategy for every single person. But for someone who's maybe sold a property for $500,000 or $1 million worth of gain, then certainly could be a very significant tax saving.
Yeah, but what you also were alluding to, I think goes to show like during a seller's market, which is what it's been for a long time, pretty much across the country, that's not the best time to do a 1031. There's low inventory right now. And like Matt was saying, you have to go up to get it. So a lot of times I found I think we did one a long time ago and we were like up against it. We had the 3 properties identified. I didn't even love them. We're just like, well, we're going to have to buy one of these. So we're just like,
right.
And then if you buy high and make a bad decision, not only could you buy, like you said, 10% high, then maybe it starts to go down in value. You pick the wrong area and you're getting like double losses when you could have, like you said, just take the cap gains and figure out how to maximize what you were doing then. Those are great points. And I think now is an important time to know, like 1031 is not a great option when there's nothing on the market. Commercial, sure, there's a lot, but a lot of commercials vacant now. So that's not going to really help on the appraisal values.
Yeah, we do have, in the past couple of years, like you said, it's been a seller's market. And some of our clients have looked into utilizing the reverse 1031 exchange. So it's a little bit of a twist on the traditional one. So in a reverse 1031 exchange, basically what you do is you purchase your replacement property first, or at least you get under contract. And then you sell your original property. It works out well sometimes because it's in a seller's market, right? So you've already have your replacement. And then the assumption, the strategy is when you list your original property for sale, that it'll be sold fairly quickly, right?
Yeah, that's really interesting. That's perfect for right now, especially if you have a hot property, hot market that is going to sell for top dollar. A couple questions on the 1031 and then we'll move on to some other stuff. But it's such an important dynamic for people to understand whether they can or cannot use it. What's the real definition of like kind in terms of investment property? Like, can you go from a multifamily investment property to a flip or a single family long-term hold? How are they qualifying what's like kind and what's not?
Yeah, it is an area that gets, I think, a lot of misunderstandings, right? The way the IRS looks at like kind is it comes down to, is it an investment property? So lack of a better term, we're looking at a rental property or something you bought with, you're just holding it for appreciation. So common example, what's not eligible for 1031 exchange is a flip property. So if somebody goes in with the intention, I'm going to buy a property, rehab it in 3 months, flip it in 3 months, that is not eligible for 1031 because that you're more like flipping inventory. You're selling inventory like a retail store sells their t-shirts or something like that, right? So it's just, a property holding for appreciation or a rental property. And outside of that, there's a lot of flexibility. I mean, you could sell a single family home, buy a multifamily. You could sell a commercial strip mall and buy a single family home. I mean, you could sell raw land and buy, a hotel for that matter, right? I mean, it's...
You could sell a long-term rental replaced with a mid-term rental or short-term rental, right? So the type of investment is pretty flexible from that perspective as well.
And you can do, if you have one big gain, like you were saying before, like $1 million gain, you can transfer that into multiple properties, or is it harder to identify multiple? Like say you have $1 million gain and you wanted to separate that into 3 investment properties. Can you do that?
There's definitely ways to do it. You may be able to separate it into more. There's, specific rules you got to follow and things like that nature. So we have seen that. Typically, more common is the other way around where you've got 3 properties and you're exchanging maybe like one, you're consolidating into one or something. It's like Monopoly, right? Get rid of the 4 houses and get the red hotel or something, But I do remember working on a person's tax return years ago where they went from, what did they do? They went from 4 properties to 16. And I was like, what? Like, you don't see it all that often. But it worked. I mean,
Yeah. Let's talk about depreciation for a little. This, I feel like, is extremely misunderstood. Where are real estate investors able to take depreciation that is a big benefit to them as investors?
Yeah, I'm glad you asked that because that is such a common area of confusion. It's really important for people to understand that if you own rental real estate, then you are eligible to take depreciation. Not only is it eligible, but you're required to take depreciation. And regardless of what type of real estate you're investing in, whether you have a full-time job outside of real estate or not. Depreciation is always available to offset taxes from rental income. Sometimes we come across people who say, oh, my tax advisor said I shouldn't take depreciation because I'm not going to get a benefit from it. You have to be really careful when you hear bad advice like that, because there's always a benefit to taking depreciation, and it is a requirement that you take it.
Yeah, and for those people who maybe don't know what it is per se, it's kind of this opportunity the IRS gives you, like you're buying, you're paying, based on the purchase price of a rental property. The IRS allows you to kind of take what we call like a paper write-off every year for a portion of the purchase price, because under the guise that it's, normal wear and tear, the property's quote unquote depreciating in value every year. Now, obviously when we're buying, we're hoping we're getting cash flow positive. We're hoping it's going up in value, right? But they do give you this kind of ability to take this paper write-off, and there's calculations involved and stuff. But that's why we, I think as tax planners, we kind of love rental real estate, because you go out and buy stock investment, you're not writing off a part of the purchase price of the stock. You're not even writing that off until you sell it down the road, right? So this is a way that their IRS is allowing you to use this appreciation to almost shelter cash flow from taxes, and maybe even potentially shelter other income from taxes that you have too.
Today's show is brought to you by Streamline Properties on Market, brokered by eXp Realty. That is my on-market real estate team. We are investor friendly. We work traditional buyers, sellers, but we also work the investor sphere all the time. House hacking, short-term rentals, flipping, long-term holds, anything that you want to do. We're experienced in that arena. We work the whole state of New Jersey, Philadelphia County in Pennsylvania, Elko County in Nevada, and the Catskills region of New York. So whatever your investor needs are, you can count on us. You can go to streamlined with a D .properties. Let's get back to the show. Yeah, what are some other areas that you guys think are just giant areas of misconception where you really have to tell people, like, this is not the way it is? Let me help you reframe how this works.
Yeah, for depreciation specifically, it's really important to understand that it has nothing to do with the down payment that you put on the property, because depreciation is based on the purchase price. So if I buy a $500,000 property, I'll get the same depreciation regardless of whether I paid all cash for that property or if it was 80% financed or even 100% financed, right? And so what that also means is that the more leverage that you might be comfortable with as an investor, the larger the potential tax benefit that you could get. If I had $200,000, if I buy a $200,000 property, I'll get some depreciation. But if I use my $200,000 as a down payment on $1 million property, now my starting point is $1 million that I get to use in terms of calculating depreciation every single year.
That's a great point. That kind of reminds me of, because you guys said Rich Dad Poor Dad was the book that kind of got you into it. That reminds me of how he talked about leverage so much in the book. Is that something that some of your clients, of course, along the way need to learn more about leverage? Because there's the Dave Ramsey philosophy of buy everything with cash. That was how my dad was growing up. So I kind of grew up like that. I never used leverage until I was in my 30s. And now I'm still starting to understand, wait, there's a lot of benefits to using smart leverage the right way.
Yeah.
I think it's all going to kind of come down to person's personal profile, like risk tolerance. What is their investor profile? What are their goals? What is the time frame for meeting their goals? But yeah, to your point, right, I'm going to age myself. I've been practicing for 25 years now. And so I got to see it in 2006, 7, and 8 when, it was very common to look at a tax return. It's like, I was telling you that good story, that my aha moment earlier where the guy was cash flow positive. There's a lot of tax returns in 04, 5, and 6 that it was very clear that people were cash flow negative. And it was like the conversation was, I don't care because it's going up in value. And it's like that quickly came to a halt, right? And so, yeah, to your point, smart leverage and do it where you're comfortable. We do have clients that are, hey, I don't want to use leverage. I'm doing all cash, and that's great. And we have clients that are the exact opposite and are comfortable based on what they're trying to accomplish, So it definitely is a personal kind of find that personal area that fits for your situation.
I think it's interesting because Robert Kiyosaki talked about that he made his wealth through debt and taxes. And it's really interesting because I think for many people, the words debt and taxes are almost like bad words. We don't want debt. We don't want to pay tax. But he reframed it kind of like the example we talked about with $200,000 down payment on $1 million worth of property and getting all the depreciation from it. I think that's the exact concept he was talking about in terms of, okay, well, how do I have debt work for me, help me build wealth, and then use the IRS tax code to help me further save on taxes too.
Yeah, that's a great point. I've had Tom Wheelwright on before, and he said something like the tax code gives you these things for a reason. Real estate investors to not use
Right.
them. It's like the government's telling you you can do this. So for you not to hire professionals who can help you accomplish things that are clearly sitting there in the code is crazy, which again, I've probably done so many times. My dad worked for the IRS and was an attorney. He worked for the IRS, started, and then he started investing as an attorney after. And he would always do his own taxes. But I was never interested while he was alive to learning the tax consequences of why he was sitting there doing it. But it's so important, and that's it right there. And you also touched on something again that we talked about before. Tax is just like it has such a negative connotation. Like you can't get away from it. So you're better off getting comfortable with it, having people protecting your interests along the way. Do you get that though from a lot of people? They just come in with this general like fear and distaste for taxes. Like, I don't want to give the government, my money, as if you could just opt out.
Yeah, for sure. But I think it depends on where they are in the, let's call it the pain timeline, right? Like, so, there's a lot of people that, hate taxes and are, I don't want to think about it. But, if you get to year 2, 3, and 4 of, hey, I just paid a crap ton of taxes, like I'm ready to make a change, and we see that a lot too. It's just like, okay, no, I know I've avoided this like the plague, but it's killing me now, like I know there's a better way to do this. Help me do it that way, And yes, for people out there, crap ton is a technical term. So.
Yeah, they all know what that means because it applies to almost everybody, real estate investors' taxes and all the documents that you've been shoving in a cupboard or something for the year. So through your guys' career, how did you start to understand more about the investing world by helping so many investors? I think that's probably really helped you in your own investing journey and knowing like, hey, like you said before, working with experts and putting our money in syndications is a great play time-wise. And also we know the tax benefits.
Yeah, it's really interesting because we kind of didn't start out where we are. We initially, when we decided to do real estate, we were like many people, we're kind of like, hey, we hate our jobs. We just want to do real estate full time. And so our plan was to become syndicators and raise money, negotiate, put deals under contract. I think we quickly realized that neither one of us were really strong in like negotiation and things like that. And we kind of try to pawn it off on each other. And
I don't know what she's talking about.
And at the same time, we both just realized that we really were passionate and we were the happiest when we were working with other investors on how to help them save on taxes, right? It's just, that's what we knew and that's what kind of our passion was. And when we started out with our real estate careers, we attended a lot of, real estate conferences, meetups, and I think we quickly realized that not everybody was able to get tax strategies like our clients did at the Big Four. So that was the first time we realized, hey, there's like everyday investors who just have no one to turn to or to teach them about how to use taxes as a benefit. And that's kind of the birth of Keystone CPA. We're like, hey, well, we are the everyday investor now. Let's just share with other people and help other people in using some of those same strategies, but just modified slightly, right? So that we can kind of utilize but get the similar benefit.
Yeah, and I would think, obviously, you guys will tell me after 15 years at Keystone, like the real estate investing community as a whole is so tight that this becomes, if you do a good job for investors, your referrals are endless because there's just not a lot of people who have the niche there for it. So it's like a very easy thing to do, like, hey, let's do a good job for this investor. And then they're going to tell somebody else because all of their friends are doing terrible accounting as well. Because we all have been for years. You don't find like many investors at a meetup were like, you know what, my investments were okay this year, but let me tell you how good my taxes were. They're
Yeah.
just not, they're not. It's an afterthought, but such
my
a huge benefit.
my accounting records are outstanding.
Yeah, exactly. Well, maybe you can create a group of boastful investors about their taxes
There you
because,
go.
but like you said before, they are doing that. Once you understand that you've maximized some benefits, that is something to celebrate. Whereas before, that's not something someone's going to put on social media. And now, saving $32,000 because you made a smart decision and got help, that's a big benefit because that's a down payment for another property.
Yeah, for sure. And, I think it's, like I said, it's what we see through our clients sometimes is that transition. You go from hate to hating taxes to just being very proud and excited and just kind of embracing taxes almost as a tool. And that's where I think for us, we maybe feel like the most gratification in seeing that shift. So maybe we'll change you one day, Jonathan.
Yeah, I need help. I'm just waiting for our podcast to end so I can beg for help. That's probably so.
I
How
feel
did
like
you
we
guys?
should rename this to be like the confession, the podcast on Jonathan's confessions or
Yeah,
something.
that seems like all of my podcasts. So, how did you guys end up writing the book for Bigger Pockets? Because that's a huge asset out there. If people can get over the hump of, hey, I want to read a book about taxes.
Yeah, it's actually interesting. Bigger Pockets had us on one of their very first few podcasts. And I think they reached out because at the time we were already doing a lot of education for, some of the real estate gurus at the time in the apartment investing, commercial space. So they had reached out to do a podcast. I think it ended up being one of the more popular ones. And so we just, thought like, I think Matt and I were just thinking like, a lot of the tax books that you read that are available out there at the time were all very dry and boring, even for CPAs as readers. So we just really wanted to put something together that was like easily understood by non-CPAs. Just like I said, average investors who knows nothing about taxes or bookkeeping. How can we help them with stories and concepts so they don't necessarily see tax as an evil thing?
But don't worry, we did change the names of everybody in the stories, so that, protect the innocent or the guilty for that matter. But yeah, we told it more in a story format. So it's kind of we think, and, based on some of the reviews we've heard, it's kind of a fun read because, hey, I can identify with this because, crap, yeah. I did this myself, so there's good, what do people do well? What do people not do well? But yeah, it was kind of just, morphed into that. And, we just actually found out recently that the first book we wrote has sold over 100,000 copies. Now, we don't write books all that often, so I don't know if that's a lot or not, but it sounds like a lot to me, So.
Yeah, it sounds really good. But the storytelling aspect of writing a book like that is really important. I saw it in Miracle Morning by Hal Elrod, because that was similar type. And then in 7L by Michael Mayer. It's a similar. They're telling a story about how people interact with it. And like you said, a regular first, second time investor who doesn't know much about accounting can then pick it up and feel like, oh, yeah, this is me. And I think that's how a lot of people feel with Rich Dad Poor Dad when they read it for the first time. And maybe you guys did too. You're like, it's a light bulb to say like, this isn't that hard. And then that's a big thing, that a service that you guys are doing with that book, where people can take the fear of taxes away. They just have to open the book. It's like, just, can you start reading a book on taxes and realize it's going to be okay?
Yeah, we've heard from a lot of people who say, once they started reading the book, like on a flight somewhere for vacation, and they can't really put it down. So we have people tell us like they've been reading it at the pool or at the beach, and their family or friends make fun of them. It's like, why would you be reading a tax book on vacation? But I'm like, hey, that's awesome. That's the best place to be reading it.
Yeah, because next year the people reading the book are going to be on an even better vacation, and their friends who didn't do the good part of the taxes will be in the same spot.
I like that.
Are there any other areas of taxes for real estate investors that you feel where people are just making some blunders?
I think we might have like touched on that at the very beginning, but a big blunder area for newer investors, I feel like, is always the concept of legal entities. A lot of people are of the opinion that you have to have a legal entity in order to take tax deductions. So I think it's really important just to point out that you don't have to have a legal entity in order to take tax write-offs, as long as an expense is what we call ordinary and necessary for your real estate business, those are deductions regardless of whether your rental is held in an LLC or held in your personal name. Of course, there are definitely asset protection benefits of having legal entities, but like with anything in real estate, it's a business decision. And so, before going out and forming 10 different LLCs, one holding the other, managed by a third one, just make sure you're talking with your tax team as well on like what is the cost involved every year, compliance, bookkeeping, tax return fees, to see where that optimal place is for you in terms of how many LLCs, how many properties.
Yeah, that's a great point because I've talked about this with a lot of people at Bigger Pockets. I think the number one question in the forum over the last at least 10, 15 years is, should I start an LLC? It's not as necessary in the beginning because people are thinking protection, but an LLC is not available to a brand new investor who's going to use a mortgage because the LLC is not vetted. So there's no way to get it into an LLC. LLC is generally set up for people buying with cash or people who have run a business in that LLC for more than 2 years with tax returns, correct?
Yeah. And it depends, depends on the lenders too. But I think you're absolutely right in that if you're someone starting out, if you don't have a lot of net worth or you don't have a lot of equity in the investment properties, it's not as imperative to have these LLCs as if someone else who has a lot of net worth or is having a lot of equity, right? But it just kind of comes down to a cost benefit. I think that, the thing that Matt and I hate seeing the most is somebody who comes to us that is a newer investor who has spent $10, $20, $30,000 on entity formation. Because that's good money that could have been used on a first property, right?
Yeah, and I can just tell it's very easy to set up an LLC on the state websites. Done it a million times. But yeah, you're right. Someone could pay $10,000 to get 3 LLCs, which they could have done in an hour and a half on a state website, and then still have nothing to put in them.
Yeah.
But at least they have the LLCs though, Jonathan.
Yeah. And it sounds great.
Yeah, they're all protecting each other somehow.
Yeah,
but I've always thought I think an umbrella policy for investors with multiple properties is just as important, if not more, than actual quantification of how many LLCs you have, because the umbrella policy provides a great protection as well.
For sure. That's we talk to clients about, it's holding title to rental properties. Do we look at using LLCs? Umbrellas, insurance is an alternative. We've got clients that do both because just from a risk tolerance perspective, that's where they fall. And I'll just to kind of, make it obvious, right? We're not attorneys, but, we can talk to clients about, hey, this is how we understand it. But we do always kind of recommend clients talk to asset protection attorneys because they're going to be able to walk you through the things that, we don't know and you don't know. And, what are the things you should be thinking about that you're not when it comes to, asset protection planning for sure.
Yeah, I have a question for you guys. I don't know if you get this a lot, but I've seen it throughout the years. There's a lot of people who use the kind of buy early for their kids mentality. What are the tax benefits of buying properties kind of for your kids, putting them in trust? How does that help you long-term tax-wise? Obviously, it's a good investment strategy for your kids. A lot of people want to do that as college funds on the appreciation of the property, but there's tax benefits there as well, I believe.
Yeah, there's different ways to slice and dice it, right? There's sometimes where it's, I think, continue to own the properties in the parents' name and you kind of holding those until, parents pass and then passing it to the kids. A lot of times that can make more sense, but from a college planning perspective, yeah, sometimes clients want to, buy a property in the kid's name, start building, kind of credit, if you will, or cash flow. But keep in mind, if your goal is to buy properties and use depreciation expense to offset your own taxes, having a property in your kid's name is not going to help you offset your own taxes, right? So that's, it's a balancing act for sure.
I think a lot of times our clients are looking at or comparing the pros and cons of maybe a rental property on Main Street for their kid versus a 529 plan.
Yeah.
And, the 529 plan, the benefit of that is that, it grows tax free. So the future money comes out to pay for educational expenses. But the money in the 529 is typically very limited in terms of investment options. So it's typically in the market, like stock market, versus for most of our clients who are very well versed in real estate, they can make a lot higher returns in real estate. And so it's kind of back to that concept Matt was talking about, where you buy property in your own name or in your trust, but then you just internally earmark it to say, okay, when Susie's ready to go to school, this money is going to go, cash flow that's accumulated will pay for that, or refinance to take the money out at that time to pay for it. So then you get the tax benefit of that property. And also there's a lot of flexibility because, what if Susie doesn't go to college? What if Susie's going to just go out and be like a superstar real estate investor or start a tech startup company, right? So you're not limited to how that money is going to be used to help your child.
Yeah. Are you seeing any pitfalls? Well, we've talked about some pitfalls, but like for brand new investors in a market like this, are you seeing any like potential accounting, not like what we talked about before of them coming to you with an issue, but actual like accounting issues that are out there for properties that they might be buying right now because of the economic climate, high mortgage rates?
I don't know if pitfalls. I think something that comes to mind is we're seeing a lot more subject to deals than we used to. And, we used to see these, again, 15 years ago. But
yeah,
so we're seeing a lot more of those come up, primarily in the, because of the marketplace with the mortgages and things. But so that's something that, if you're going to do a subject to deal or even a seller finance deal of some kind, you need to kind of have some sort of knowledge base there that you're not, walking into a landmine that you're not aware of, obviously.
Yeah, I think with the higher interest rate, our expectations will see a lot more of these creative financing deals. I know Matt mentioned subject to, but real estate investors are so creative. There's all these different types of transactions that we see structured. So I think it's really important that if you're involved in a creative financing deal or even just in a partnership with someone that's not just you and a spouse, always have both your legal team and your tax advisors review the contract before you actually sign it, because we've seen cases where a client thought that they own the property through creative financing, when in fact, when we looked at the contract, they didn't actually own it. It was that they had an option to buy it in the future. And from a tax perspective, that's like a whole different treatment. And also legally too, right? What is this money I've been paying?
What's my recourse?
Yeah. What do I actually own?
Yeah, but that's another good point that goes for having a team set up, especially as you grow a portfolio. You need to have your team, which is, your accounting team, you need to have an attorney team. So just like you said, so you can say, hey, look, I have this deal. I think it's subject to, what are my tax consequences for this, and send it over. And that's like an easy look for you guys because you know exactly what you're looking for. But if you get a call from someone you've never met that says like, hey, I want to, can you just review this one contract? You don't know what else they're balancing against, which makes it tougher for you guys to do your job.
Yeah, exactly. I feel, for tax planning, to do it right, it's really a comprehensive analysis. So when we work with clients, it's generally not just about one property, one transaction, right? So we need to have a general idea, like what else they have going on in terms of their job or another business or what their spouse is going on. And, helpful if we also know like how old the kids are and what the kids have going on too, right? Because all the family finances are very intertwined.
Yeah. Well, I think you just helped a lot of people save a lot of money. But if they want to contact you guys directly, do work with Keystone, where's the best place? Is it at KeystoneCPA.com?
Yeah, our website's probably the best place to start. So yeah, KeystoneCPA.com. We got a lot of information, educational materials on there, a lot of, resources on there people can check out and, find stuff that applies to their situation. You can also find, she's very active on social media. I'm more in the background, and you see some of her pictures. I'm in the background, but
yeah, I'm mostly on Instagram as Amanda Han CPA. So yeah, check that out. I try to post, daily tax tips because I understand people don't love and are not obsessed with taxes like we are. So try to do, like 15-second little golden nuggets when I can on tax strategies.
Yeah, I think they're really helpful because one of the overriding themes of this whole show is the fear of taxes. So to be able to give people snippets and kind of, younger people can get it. And so it becomes less scary over time when you're just taking, TikTok snippets or Instagram reel. Oh, wait. That's a good tip. Let me write that down. And then it's something maybe you remember later. And that's where I think social media for, careers like accounting, where people would have said 10 years ago, what's an accountant going to do on Instagram? And now you're like, well, here's exactly what they're going to do. They're going to help people in small bites so that they eventually can make the way to the right decision and stop being so scared. Awesome. Well, thanks so much, guys. It's been an absolute pleasure having you on the show. I'm going to have to read the full book because I haven't read it yet, but it's going right down. But it's for the same reasons that I've said. It's like you think that it's going to be more difficult. And then when you change your mindset to like, wait, this could unlock huge savings for me, it's going to help me then take the next step to hire the pros to do it. I think it's great. So I really appreciate the time that we spent today.
Yeah, I would love to get some feedback once you've read the book, where you read it, how long it took you, and what you thought.
Yeah, I'm quick, so it's going to go through real quick. And then it's going to be how much help I need. So you guys already know that you're in for that. I appreciate you coming on the show today. It was great.
Yeah, well, thank you, John. Thanks for having us. Appreciate it.
Thank you.
Absolutely. That was episode 71 of Zen and the Art of Real Estate Investing with Amanda Hahn and Matt MacFarland. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.